You're watching Famous Game on YouTube.
What's up, dudes and dudettes of a VIX Persuasion? You're watching the Short Vol Show live on YouTube, broadcasting from Cape Cod, Massachusetts. And just to give you a little update here, we're going to talk about GameStop and some VIX stuff. And, oh wow, this light's right in the way. Hold on. Move that light out of the way. So anyway, yeah, I've been a little busy lately. I had this sort of side job that was like 1 day a week or something, and all of a sudden they installed these igloos. It's at a local resort. They installed these igloos, and all of a sudden they want me working like every day, all day, nonstop. I actually made the front page of the local newspaper with this shot, which I put on up on social media as a server working igloos. So all of a sudden, I'm like working this job every day. So I'm not too happy about that. Hopefully it won't last too long. But anyways, so that's why I've been a little bit scarce around here lately. So let's get on to market news. GME yesterday, amazing moves. I know this is non-VIX related, so bear with me. We'll talk about the VIX first, then I'll get on to GME and the moves yesterday and kind of my thoughts with trading it a little bit. I think I made a grand total of like $100 trading it yesterday. Anyway, $100 is better than losing, right? So the current VIX strategy that I have on is what I refer to as the bullseye strategy. And what that is I'm short calls, and I don't encourage others to put this strategy on because it is incredibly risky. I would encourage people to have a strategy that limits your risk. But regardless, this is the position I have on right now, and I'm just leaving it for the time being. And so what it is I'm short front week calls. And let me adjust my screen here. I'm short at the money calls in the front week in VXX. So if we look at VXX here, I'm short 5 of the 16 calls for this week. And the whole strategy is very simple, like I said before. Sell the calls, hang out until Friday. Now, Friday at expiration, either these go out worthless, and if it's right at the strike, then I buy them in for 2 cents or something. Or if they are in the money like they are right now currently, I roll them to the same strike next week right before expiration, and I just leave them. The pluses of this strategy are that you are collecting premium every week with the most rapidly decaying option on the board. A quick and easy way, which is not the right way, but if you're lazy, you could use to assess how much premium is in these calls, is to look across to the put. So we see this put here says 13 cents at 15 cents. So that means that there's somewhere around 14 cents of premium in this option. Now, the less lazy way to do this, and the right way to do this, is you would take the price of this call and you'd add it to the strike price, right? So let's say call this $1.10 plus 16, right, is $17.10, and then you would subtract the underlying price. Right then, the underlying price was, underlying price closed at 17.06, right? So 17.10 minus 17.06 is 4 cents. So based on these calls being marked at 110 versus 17.06, there's 4 cents of premium in the call right now, which is not very much. There was more premium in these calls when they were closer to at the money, but with a pop in volatility, this product went up and resulted in these being marked with less premium. However, this strategy, however it looks sort of awkward right now when we look at it on paper, over time it produces good results because every week there's premium in this option that just decays. And with VXX slowly going lower, you're going to participate in the down move, plus you're going to get the decay on top of it. So over time, this strategy should be very effective. We'll see how it works out in this case. But being very disciplined with this position, sold a few calls, and just we're just going to roll them out and not touch the position other than that. That's the only options trade on this position, and we're going to see how that works over a period of weeks. Once again, I'm cautioning people against putting on a similar position to this because it's very risky. If the with this account size that I have right here, if we had a 50% move up, it would my buying power would be reduced to 0, and I would have to buy a call or two in. If this were to go 100% up, I think it would like dissolve the account essentially. So this is a very risky position. I'll say that again and again and again. Do what I say, not what I do in this particular case. But we're just going to play this out to see how this works as an experiment for the time being. If I do go to the Analyze tab here, for example, 100% up move. All right, so we don't lose the whole account if it goes up 100%, but it comes close to that. And we would be forced to cover because buying power would go up to 17,000. So that is what it is for the moment. Joy, I just wanted to talk about that for a second. Let's go now. Yeah, so it says, how do you defend if it goes against you? Roll them in a week. Yeah, so you just keep rolling this position out, right? If it goes against you, you just roll it out. And it probably would be more responsible if the position was about half the size, if I was short maybe 3 calls instead of 5. Let's just quickly model that. So I'm going to go in here and I'm going to sell. I'm going to click on the bid so that I can, in my Analyze, get rid of 2 of these calls. So let's say if we, sorry, I need to buy them back. So if we were only short 2 calls, then up 100%, we would lose half the position, and we would still be forced to cover, but just barely. That would be for a 100% up move. But yeah, the strategy is every week you continue to roll them, or if they go out worthless, you initiate a new trade with at-the-money calls. Now, I know some people that do this trade all the time, and yes, you can get blown up. That's the big risk with it, but we're going to check it out and see how it works just for the moment here. It is a strategy that works well whether you're going sideways or down, which is has some advantage over having a position where you're having to pay theta every day. But we're just going to leave that and see how it works for the moment. Let's take a look at VIX Central and our VIX term structure very quickly here. And my screen is going to, there we go. Beautiful. And we see that we are back to 6% contango. We had a little pop the last day or so, but it seems to have kind of straightened itself out. We're seeing more and more calls for a market down move, and obviously there's always calls for a market down move. We still haven't gotten that push below 20 in the VIX, which I was sort of anticipating, but it just hasn't come. However, staying at 6% contango, these products will continue to decay over time. It's not a very exciting trade right now. These VIX products have not been an exciting trade for some time. Last year was a bad year for VIX trades, and we'll see if this year is any better, but essentially these products have just been kind of sluggishly sitting there. Look at this kind of sideways action in VXX over the last couple months. If we back it up a little bit further, you can see we're still kind of coming off of that big spike earlier in the year, right? We're still not back to where we were last February before the spike. We're close to where we were, but it's taken a whole year just to get back to where we were, which is boring and frustrating, which doesn't make for good YouTube content, for one thing. All right, so GME, let's just take a look at this. I got sucked into playing a little bit of this one yesterday. Just amazing action. And if you were following this over the last couple of days, you hear a lot of retail people and even people like on TV saying, identifying this as a short squeeze. This, of course, being associated with this Reddit group, Wall Street. Let me see what the name of the group is. This people are saying that this Reddit group has perpetuated some of these squeezes. I find that a little hard to believe. I would think there has to be more money. Wall Street Bets is the name of the group, which supposedly has been taken off of Reddit, I think, or at least I read something about that. Reddit moderator slams Wall Street fat cats as GameStop's wild ride continues. Reddit traders look to pummel Wall Street's old guard. Jim Cramer says Wall Street Bets Reddit has altered market. Wall Street Bets Reddit, et cetera, et cetera. Anyways, it is what it is. And what happened with GameStar is that we had a squeeze that was widely reported in the news. We're going to go to the chart here. I'm going to go to 20-day. And let me get out of the way here. We had a squeeze that was widely reported in the news here where we went from basically 20 to 40. And then that was a couple weeks ago. And then they were talking about it. And this, I think a lot of people got kind of trapped here because they thought they were smarter than the market. They came in, they said, oh, this is a squeeze. It's definitely going to go down. And people came in and shorted it around here. And then it really started getting squeezed. There was some hedge fund. There was a hedge fund that said they got that was shorted. They got an additional investment from Citadel and another hedge fund yesterday to hold on to their short. But if you thought that squeeze to 40 was big, we had it to 70 the session before. And then yesterday's session, it was up over 100%. It got up to 159 and change. The market actually was, at one point, when it halted, the market was 136 bid at 164 yesterday. So just amazing price action. I think this is record-breaking price action here yesterday in GameStar. How did I play this? These things, you want to be really careful, and the first thing you want to do is not lose money. I know that should be obvious, but when stuff is like all running crazy like this, you get all excited, and sometimes you lose your head. So we don't want to do that, right? We're disciplined traders. So my thought was that I would sell some puts when it was right before it halted up here around 159. I went ahead and I sold some of the, let's see if I can get my orders up in here somehow. I went ahead and I sold some of the, I can at least show you my position here. So we got up to like up here. I sold some of the, two lot of the 20 puts. Actually, I sold one of the 20 puts, like plain old 20 puts, for $1.08. And I figured, well, if I sell the 20 put for $1.08, what's the most I can lose? Let's say I sold it for $1. What's the most I can lose if I sell the 20 put for $1? The answer is, of course, $1,900. If this goes to zero, I would lose $1,900. The puts were like 2 weeks out. So I figured, well, that's, the volatility is so cranked, I should have an opportunity to buy something against this put that I sold for $1. And indeed, the stock went from up here, it halted right after I sold the puts. It went all the way back down to 80, and the puts, they barely moved. They got up to like $1.20 or something like that. So then, during the middle of the day here, when it was around 100, I decided I was going to jump in again, and I bought one put. What did I buy? I bought the front week, the 50 put. I paid $5 for one of the 50 puts. And then it dropped 20 bucks, and so I sold. I paid $5. I think I paid five or 5.10 maybe. Let me see if I can find out here. View trades. So I paid 5.10 for one of these 50 puts, right? So then the stock dropped, and I sold one of the 48 puts for 5.40 right here. So that's a good trade, right? So I bought the 50 put for 5.10. I sold the 48 put for 5.40. So I was like, all right, so it's a put spread for 30 cents credit. Then I went ahead and I bought the 46 put, and I paid 4.80. And my thought with this was that I would buy this put, try to ride it down a little bit, and then sell another 48 put against it to put on this butterfly for good prices. And so that actually worked out for me. I bought this put, paid 4.80, and then I was able to sell one of these 48 puts against it for 5.64. So I figured that was like around 80 cents. I basically sold the $2 put spread for about 80 cents. So that got me, so I was collecting theta on the position. But I was still short a couple of these 20 puts, or I was short this 20 put and this 19 put. So I ended up actually turning around and turning these puts into a calendar spread. I bought the 20 put the next month out against it for $1.34, and thus I was paying 34 cents for the calendar spread. And I figured that was kind of a safe trade. It got my buying power back, because selling even though these puts were so far away from the money, it killed my buying power. So I was able to buy this calendar. And so anyways, the end result was I made 74 bucks. So it was it was a lot of work for not very much. I am still short one put, and we are up 10 bucks. So I'll end up making money on that one, and we'll see what happens today. But I guess my point in the whole thing is be very careful if you're going to jump in on these things. You know, the sucker play was to either sell naked calls or short the stock, because obviously it went, in people's face huge, so they were forced to buy it back at way higher prices. So if you're going to jump in on one of these things, the point is be very careful. And I know that's kind of obvious advice, but well-needed advice. You see one of these things moving around, you get all excited. You're like, I want to jump in, I want to jump in, I want to jump in. Limit your risk. Always be thinking, how do I limit my risk? What's the worst that can happen? Because in these situations, the worst thing that can happen happens more times than not. So I think that this thing is destined to go back lower. It seems very obvious that it's going to go back lower. I just don't know when. So if you can construct... the other thing with this is that they would not let you trade complex trades yesterday at all. So you could not actually put an order to buy a spread in. You had to leg into it one leg at a time. And the good news with one of this crazy type stock is when you have wide markets, you could put a bid in that's like just 10 cents better than the bid on the screen, or an offer in just 10 cents better than the offer on the screen, and you could get filled a lot of times. There were very wide markets, and if you just put a bid or an offer in, you got filled. So that was an advantage to jump in there. I feel like this is definitely going to go lower once the hoopla dies down a little bit. There's plenty of other places to buy your video games besides GameStop. This is just getting squeezed, but I don't know when that's going to happen, and so I would be very careful. But legging into a put spread for good prices seems like a no-brainer here, as long as you pick a month that's kind of a little far out in time so that it doesn't expire before this thing inevitably moves lower, which I think it will do. Anyways, I'm not advocating for anybody to do anything. I'm just describing what I did in the hopes that it helps you with your own trading thought process. Reddit Wall Street Bets. Yeah, so it might be a good time to check out Wall Street Bets on Reddit too. I mean, it's interesting. They are being blamed also for another couple moves yesterday. And there's a bunch of stuff on Wall Street Bets if you want to read it. There's articles coming out all over the place. Let's see if we can find something here. So it was the second highest trading session for call options. There are 32 million call options traded in one day, which is the second highest ever. The stock was halted 9 times because of volatility yesterday. Hedge fund Melvin Capital Management got slammed for being on the short side. And I believe, and it says, it received much-needed cash infusion from fellow hedge funds, 0.72 in Citadel, the Wall Street Journal reported. Retail traders are beating the old guard for now. GameStop short sellers have market-to-market losses of a whopping $6 billion so far this year. But it ended badly for the Redditors, it says. So I guess the Redditors are being thought of as being long this, and the retail is being thought of as being, and the hedge funds are short it. Now, that's really, really oversimplifying, right? Because we don't know what everybody's positions are. Maybe, I'm sure there's some hedge funds that are along this too. So just because the stock went up doesn't mean that retail's beating hedge funds. That's a bunch of gobbledygook. This is like financial media trying to dissect the situation. So, who knows what positions everybody has on. The bottom line is there's volatility. It doesn't matter where it comes from. I don't think that, anytime you've got a move like this, these people come out with saying there's going to be lawsuits. And I would not use the fact that there's potentially going to be lawsuits to short this as an idea to short this, because every time something moves, people, jump in with these lawsuits. The bottom line is it doesn't matter what other people are doing. It matters what you are doing with your own position. So, like I said, I was very small doing putting one lots in yesterday. But the thing is, when you've got something that's whipping $5 a minute, with one lots, you can make money, because if you can buy one strike and then sell the next strike below it for higher, then you're locking in free spreads. The key to all this is do the hard side first, and then also recognize what you're doing. I was looking at maybe I'll try to buy a calendar spread that's sort of at the money. But with an $80 stock, the at the money calls, even in the front week, were $20. So if you're paying $2,000 for one call, you need to be you need to be very careful. But, keys for me are, if you're an option buyer in this situation, the most you can lose is what you pay for the option. If you're selling puts, the most you can lose is the distance between the strike and zero. And I'm looking to spread stuff off and not trying to be greedy. If I can make 50 cents, if I can put a spread on for 50 cents credit, then that's great. And I don't try to get greedy. And then recognize that the volatility is going to crash in this at some point. The vol was up to 600 for a while in here yesterday. Obviously, that's going to crash down. The farther out months have bigger vega, so if it's riskier and riskier volatility-wise the farther out you move in time. But if you do leg into a vertical spreads are going to cancel out any of these volatility concerns, right? A vertical spread is a great way to trade these particular products because it takes that volatility out of the equation, and it doesn't matter how high vol gets. If you can buy one option and sell another, the vertical is still a vertical, and you can analyze that and say, how much am I paying for what sort of move? Am I paying 3 to get 1? Am I paying 1 to get 3? Et cetera, et cetera. It is a little scary, though, legging into this stuff, and this thing's popping again into the open today. I kind of see it as an opportunity to get short here at some point, but who knows? It could go straight up. We could see this go to 160 again today. So be very careful if you jump in. I think I'm pretty much done. I'm going to just either leave my position or unwind it. We're here to make money, not have, excitement. and we'll see how it goes. So there you are on GameStar and Wall Street Bets. Thanks for watching. I've already talked too long today. I'm going to leave you, and we will see you very shortly. Yeah. Oh, just one strike traded more than all the Apple. You know, the other thing with GameStar that was funny yesterday is like right on the open, the highest strike was like 100, and it was trading like way above 100. And so I was like, well, what's going on? You know, the other one that I traded recently that I was successful in that had a big move was Kodak, but that was a little bit different. Kodak ripped up and then it just crashed straight back down. Let me see if I can find that really quickly. And it was kind of like over in one day. This one obviously is kind of a multi-day situation. Let me see if I can just find that Kodak move. All right, so here it is. Let me get out of the way. So this one, you know, it rips to 60, and I felt this was less volatile in a way, and I felt very comfortable on the second day. I was selling the 60 calls, right? Selling naked 60 calls for like $1 or $2, something like that, and it just went straight down from there. At which point I just closed my position. This GameStar one seems to have legs, and you're a braver person than I if you're going to be selling calls. I was looking at the GameStar. I think it was like the 150 calls yesterday. We're trading $12. Now that seems like, you know, an obvious sale, right? That's a free $1,200. However, who knows? I mean, the thing could blast back up there, but I find it very doubtful that will blast back up there. But, you know, if I was trading with a bigger account, I would have launched a couple of those. You know, $12 for the 150s. This thing is not going back to 150. Mark my words. But I'm too afraid to sell those calls. I'm not. You know, I don't want to risk my account blowing up, so I'm not doing that. But I believe that will turn out to be a great sale. $12 for the 150 calls a week out in GameStar. Craziness. All right, so it's fun to watch these things, but we don't want to blow up our account playing, right? We're here to make money, not play. Yeah, they Dazboff, I noticed that they did put in strikes during the day, which was good. We'll see. It's kind of frustrating that they don't let you do complex trades. And they should have something on like Thinkorswim that tells you, oh, you can't do complex trades, instead of you just finding that out. Because a lot of times they change these things like right on expiration day. They're like, you can't open on expiration day or some craziness like this, that they make up their own rules like on the fly, which is really annoying. Anyways, I'm going to let you go. I'm talked too long already. Thanks for watching. We'll see you next time.
You're watching Famous Game.